The disruption the pandemic has inflicted on global supply chains is really starting to harm consumers. Prices for most items are up double digits in the past year, and product shortages are rampant these days. So how much longer is this pain for our pocketbooks likely to last?
I think this will drag well into 2022, maybe longer as far as the automakers is concerned. I think there will be particular issues that will drag into 23.
Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, welcoming you back for another week of making sense of money and the markets so that you can make better informed decisions about building your wealth. The world has been watching prices rise dramatically this year across nearly all asset classes, in large part caused by the trillions of dollars in monetary and fiscal stimulus flooding into the economy, as well as the disruption of global supply chains caused by the COVID pandemic. But not only are consumers experiencing rising prices at the store, they're increasingly finding empty shelves too. On the supply side, things have become so bad that today's guest expert, Richter, has coined the term the everything shortage to describe the era we're now entering. Wolf's the founder and publisher of wolfstreet.com, where he reports on and dissects the many complex entanglements, debacles, and opportunities offered by today's markets. Well, the current supply chain mess sure sounds like a complex entanglement and a debacle. So I'm very glad you could join us today, Wolf, to shed some much needed light on exactly what's going on here.
Well, thanks for having me back. Yeah, this is we're in a crazy situation. I have never seen anything like this, and the poor purchasing managers out there trying to procure things. They're running 100 miles an hour trying to keep the operations supplied. It's one thing after another. Some shortages, there were shortages last year, are kind of resolved now. There's new shortages coming up. The weirdest stuff is suddenly in short supply. And you're talking about consumer goods a minute ago, but it's really, it's home builders, it's big construction companies, it's in a major way, the automakers, because of the chip shortage and some other shortages. It's consumer electronics manufacturers. It's not just in the US, it's global. And it cycles through from one item to another. It's just a bizarre situation. And obviously, as you pointed out, the enormous amount of stimulus caused a huge amount of demand for durable goods. That's really what we're talking about here, is durable goods, and largely, yeah. And even though some ag products are now getting impacted because of the fertilizer prices shot up, and then the shortages in terms of keeping the tractors running and those kinds of things. So it's percolating all around, but mostly it's durable goods. And the demand for durable goods in the United States has been just spiked with all the stimulus. And during the pandemic, it was just a huge burst in demand for durable goods. It continues. And we've seen that in the retail sales, and we're going to see it in a little while in consumer spending numbers. And so you have this enormous amount of demand, stimulus-fed demand, and hitting a variety of different supply constraints, transportation issues. In Asia, you still have manufacturing plants that periodically get shut down because of COVID infections. So this is really what's happening here, and the solution would be to cut back on demand, bring demand back down to where it was in 2019. And these things will go away pretty quickly, but that's not happening. So what we've got is ongoing demand going crazy, and supply not being able to keep up.
Okay, so I'm going to dig into kind of both sides of that ledger. Let me just sort of start maybe a couple of steps back, which is what exactly caused the disruptions to the supply chain? I think COVID was the trigger, but can you just provide a little bit of color? Was it? It seems like it wasn't a. Well, who knows? Maybe it's overwhelming customer demand, but it could be that ports are backed up because for a while, either ships weren't leaving or now they don't have enough workers to run the ports. I don't want to put words in your mouth, but I know it's multifactorial, but what are the biggest issues that have really snarled up the supply chains here?
So I think each item has its own costs. And that's why it's not easy to fix. It's not just one thing you can fix. Each item has its own cost. So I'll take an example. It's kind of a cute example, but it's really hugely important now. And at the end of May, I reordered my Wolf Street beer mugs. And I was one of the first ones to point out that they were in back order. I cannot get the blank mugs. And so a couple of months later, it turns out they're not making them until sometime next year. They have prioritized, so the glass manufacturer has prioritized other products rather than a beer mug, because beer mug has a lot of glass in it. It's heavy, it's 2 pounds of glass, and it costs very little. So they're running short on glass, and they're making stuff that they can make more money on that use less glass, such as wine glasses. So now, no big deal. But restaurants are now complaining that they can't restock the glassware. And restaurants in San Francisco are booming, and so now there are reports that they're having trouble reordering glasses, and they're going through a lot of glasses in restaurants. And builders can't get the glazing, so they can't finish the buildings because they can't put the windows in. And those high rises being built with glass on the outside, and they're stuck. They're not moving forward. Apartment buildings, the same thing. Home builders with their single family houses have complained about that. So this is a glass shortage that has nothing to do with the chip shortage. It's completely separate. It has different costs. I don't exactly know why there's a glass shortage. There's a huge demand for these products right now, like light fixtures and all kinds of stuff. You can't get any more back ordered for months. And then you have the semiconductor shortage, which, we talked about that a little bit. It's not just one semiconductor. At first, it was these cheap old little semiconductors that you use for door locks and rearview mirrors. Now it's other semiconductors. And I mean, it just cycles through. This is a completely different issue than, for example, the bicycle shortage we had seen last year when an explosion of demand suddenly drained the supply chain of bicycles and bicycle parts. So everything has its own issue there. Let's look at a food item, meat. Prices of meat have doubled in some cases. So my wife works for a meat exporter, and they're buying meat by the container, and they're shipping them to Asia, and they're dealing directly with the packers. And the packers have taken off some deprioritized items from the list. You can't even buy these cuts at all. Other prices, other cuts, they have doubled their prices, and they're making a huge amount of money, but they're using these kinds of shortage issues, to raise the prices and make their production more efficient, which is that they're cutting down the number of cuts they're offering. And so everything is different. Now we've got the transportation issue on top of that. So a lot of the durable goods are imported from Asia. We have this huge backlog of containers at every port in the United States. There's ships waiting outside the ports. So anytime that cannot get into a port, that's a container that cannot be unloaded and that cannot get sent to a shipper. So that shipper has goods on the dock but can't ship them because they can't get a container to ship them in. So we've got a container shortage. So it just cycles through. It's one thing after another, and this is why that's not going away. The container shortage we've had since last year. I've been writing about it for a long time, and they're so interwoven, these shortages, and it's so multi-level and so complex that it's impossible to just fix one thing. So the Port of LA could be open for 24 hours, 7 days a week. If they finally can staff up, and if they can do that, that's great. So they will get more merchandise through the port, but then will they have the trucks and railroads to be able to take the containers away? And that was the problem a little while ago. the major railroads stopped taking containers from LA to Chicago and some other rail yards because they were backed up in those rail yards and they couldn't absorb any more containers there. So, if you resolve a bottleneck on one end, you're just going to hit the next bottleneck. And it's that kind of situation now. It is a complete mess.
Well, so Wolf, this reminds me an awful lot of an exercise from my business school days. I've mentioned it once or twice on this program, but it's designed to instill an appreciation for you in what's called the bullwhip effect, where you have this very, very overly simplified supply chain. And the professor sort of runs 10 different demand cycles through the supply chain, and he asks everybody to, after the example's over, to come up and chart what demand curve they saw. And everybody's demand curves are different. And then the professor shocks the class by saying, hey, you all had the same demand. And of course, everybody argues on whose curve was the right one. And then he later reveals that indeed the demand going through those 10 cycles was flat for the first 5, changed once, and was flat for the second 5, meaning it was about as simple a demand function as you could experience. And yet everybody had these wildly different curves. And what it's designed to show you is as people are starting to forecast, that's the part where everyone's making up their own forecast in real time, you introduce variability. And then you start having overages and underages, and people are reacting to those. And it just creates these bigger and bigger propagation waves of variation in the process. So you take that to the global supply chain, right, which is infinitely complex. And we've had people, as you said, it's multifactorial, and you can completely fix one part of it. And yet, there's a new constraint or breakage elsewhere in the chain that keeps it from actually working efficiently. And it just seems to me like it's kind of the biggest world experiment or real-time experiment of the bullwhip effect, probably that we've ever witnessed. And so I guess I want to move on to, how long we think this is going to last and how bad we think it's going to get. But very quickly, the simplistic way that I'm looking at it is we had the initial coronavirus global lockdowns, and demand for lots of things, fell off a cliff very briefly. But then once, the government started stepping in, both supporting markets and then paying people stimulus directly, people began, there's a little bit of a wealth effect where people felt like, okay, I've got some extra money to spend here. Maybe I'm at home and I'm going to buy some stuff to fix up my house while I'm here and make it look a little nicer, whatever. But we created this artificial demand wave where we were pulling demand from the future into the present with all the stimulus that was going on. And suddenly providers started running really low on inventory. The problem is that a lot of workers couldn't necessarily go back into work immediately right away because there was sort of variations in the lockdown across the globe. So you had factories that got overwhelmed with orders. And now, you have instances where factories that would love to hire people to meet demand for a long time weren't able to because people were getting enough stimulus where people were very choosy about when they wanted to go back to work, which sort of exacerbated the whole thing. So it's all these different things going on. But is that sort of the main inputs that led to this crisis, or are there other factors I didn't think of that you think are important to mention?
Yeah, I think you nailed it. Those are the main inputs. And I didn't mention the labor shortage. This phenomenon of having so many unemployed people and having a labor shortage, but that's a real contributor to the overall shortages because that impacts transportation, it impacts manufacturers, it impacts the whole distribution channel. So that's a very large contributor in not just in the United States, but in other places too. So I'm glad you brought that up.
All right, look, we're before we get onto the stuff that I just mentioned, I want to get to, I do want to just show a couple of charts of yours because you've been following a lot of these shortages very closely. I'm going to put up 2 charts here. The first is auto sales, and then the next is inventory for vehicle and parts dealers. And you can basically see here that inventories have just been plummeting. in the automotive industry, right? And that's been due in large part to the shortage of chips that you mentioned earlier. But it's just been insane what's going on in both the new and used car markets. And I know you've been following it really closely, Wolf. So I just want to give you a chance to opine on that briefly, given how closely you've been following it.
Yeah, so new and used vehicles are somewhat separate, but they're tied together. So the used vehicle market has an inflow of vehicles that comes from rental cars and from lease turn-ins and from trade-ins and repos and so forth. Rental cars roughly contribute close to 3 million vehicles a year to the used vehicle market in the United States normally. Well, so rental cars, rental car companies last year got in real trouble. 2 of them went bankrupt, including Hertz. They stopped ordering units and they started defleeting last year because nobody was traveling and the airport business had collapsed. So they got the inventories down last year. And so this year, with the semiconductor shortage hitting automakers, they cannot get new vehicles. So not enough of them. And so they have whatever inventory they have of vehicles that kept them longer, and so that they can satisfy their demand. So the flow from rental car companies into the used vehicle market has completely been disturbed by the rental business itself. You know, how it got hit from COVID, and then it got hit by the semiconductor shortage. So the used vehicle market is short on vehicles, but not desperately short. Despite the fact that there are used vehicles out there you can buy, prices have just completely spiked. I have never seen anything like this. I mean, you're very likely to pay more for a 1-year-old vehicle now than you would pay for the equivalent new vehicle. And with trucks, that was particularly glaring. Pickup trucks. I mean, it was just insane how much that jumped in prices. Now, used vehicles backed off for a few months in pricing, and with inventory coming up a little bit, and now it's taking off again on the wholesale side. You know, so the prices have started to rise again on the wholesale side, and the charge is just completely insane. But there are used vehicles out there. The market is not completely depleted. Now, the new vehicle market is essentially depleted. You know, what's in inventory now is what nobody wants, and the hot models that you either have to order them, or dealers sell them when they come off the carrier. They don't sit around very long. I just checked a big Ford dealer here in the Bay Area, and they have the ads, and it looks like they have stuff. And so I looked at a Bronco and a pickup truck and at a car, and they had it advertised. So I figured, they have some vehicles on the lot. And then when you try to buy it, you have to order it. They don't have it. They advertise it, but they don't have it. They don't have anything hardly. And this is the issue right now. You have a fairly strong demand for vehicles. We don't really know how strong it is anymore because buyers have gotten frustrated. Inventories there's nothing to buy. You have to order. So we don't really know if suddenly all the inventories were up to capacity, what sales would actually be. We don't know how frustrated people have gotten. Maybe there's not that much demand anymore. But right now there's enough demand to absorb whatever supply comes in, and dealers have jacked up their prices. Everybody in the industry is making a ton of money on a per vehicle basis. They may sell fewer vehicles, but they make a huge amount of gross profit per vehicle. The manufacturers have cut their incentives way down. The average transaction price for new vehicles has now hit $42,000. It's the average transaction price across all brands. That's up like 20% from 2 years ago. And it's just insane what's happening out there. And it's not getting better. So we were supposed to get more chips in later this year. That's what they said earlier this year, but it's not happening. There's new rotating shutdowns of assembly plants all over the place. It's just, we got the industrial production numbers today, which included motor vehicle and parts production. It is way down. It plunged. That's what pulled industrial production down is the production of motor vehicles and parts. And they're down because they don't have the parts to build stuff. And so this is mostly semiconductor related. There's some other shortages of plastics and different things, but it's mostly semiconductor related. And it's now all kinds of semiconductors, and some automakers getting hit harder than others. Ford got hit really hard earlier this year. Now it's getting some semiconductors and parts. So it became #1 in sales in September because GM and Toyota fell off a cliff with their semiconductors. And it's a gigantic struggle to keep the plants running.
Okay. Yeah, I mean, so huge issues for the manufacturers themselves, and of course, huge issues for the customers that they service. You mentioned that prices are up 20% to 2 years. That, folks, that is inflation. That is the kind of inflation from the 70s that we really don't want to have to experience if we can avoid it. But it seems like, given everything that's been going on, that's the future we're inheriting right now. So the big question, Wolf, obviously, is how transitory is it going to be, right? And of course, the Fed is still holding on to the transitory prediction. I think many people are beginning to sort of think that transitory means something different than the way in which the Fed's using it. Real quickly before I get there, and I want to actually use the semiconductor chips as an example to talk about how prolonged this period might be. I just want to dial through a couple more charts of yours. These charts are showing the inventory to sales ratio for several industries. We've got the food and beverage industry. By the way, folks, all these charts are charts that Wolf has put together. The clothing and accessory industry, general merchandise industry, and then just all retail together. And you can see in each one of these that inventory is just, the inventory to sales ratio is just plunging, which basically means that inventory is plunging in these industries. So it's not just the auto industry; it's really across the board. So it's a very widespread problem. Now, how long is it going to last? Wolf, I'd love your answer to that sort of in general, but let's talk about the semiconductors, because people, this topic's come up in some previous videos I've said, and people said, hey, it's not really the shipping lanes. You don't have to worry about that. Chips are so small, you can pack a ton of them onto an airplane. So it's really not, the supply chain so much. Is it just manufacturing these things? Are they just not getting the inputs they need to create enough chips? Or are the chips getting, abandoned somewhere along in the system?
Well, the supply chain for automakers are really complex, and they take a long time to build, and they're very inflexible. So when a chip is specified for a certain component, you can't buy a different chip. It has to be that chip. And so there's no flexibility. You can't, I just got a new server for my website, and there's plenty of servers out there. I wasn't particular. I just bought whatever they had, and so on that basis, you can dodge supply issues. If you don't care what kind of vehicle you want to buy, you buy whatever they have, and you get something. They have something to buy, but an automaker can't do that. So, and it takes the chip goes into a component, and the component goes into an assembly. And they're made in different places. And the assembly gets shipped to some manufacturing plant that puts it into the vehicle, so the assembly plant. And so there's travel times involved. And then, you have the supply chains being very long. And I gave you a very simple example, but this goes far back, and automakers are trying to control this. And so even if you got the chip today, you wouldn't get the part to the assembly plant probably for a few months. So even if the original component maker that needs that chip and can't get it, even if when they get that chip, that component still doesn't show up at the assembly plant where it's needed for a while. So, that's an issue that everybody's dealing with. Even when some of the chip issues are being resolved, it takes a long time for the parts to actually show up in the vehicle. And then there's new issues with some other chips. And like we've seen Toyota struggle with that. Now in September, suddenly it ran out of capacity to manufacture. And so, how long will this last? Well, they haven't resolved those issues yet. We're still having all kinds of chip problems. And then if they resolve all those issues, it will still take a whole bunch of months for that to actually bleed into the assembly plants. So, you know, 2022 for automakers was early 2022. That's already been discarded. Earlier this year, you know, it was third and fourth quarter 2021. So that would be right now. That's been discarded. Early 2022 has been discarded. Now people are talking about 2023. You know, for all these problems to be resolved, I think you will see some issues go away and some be stubbornly recalcitrant. You know, but if one chip is missing on a vehicle, you can't sell the vehicle. So that's the issue. You know, it doesn't really matter whether 10 chips or one chip is missing. You can't sell the vehicle. The whole assembly plant has to stop, or they manufacture the vehicle as best as they can and leave it unfinished on the lot. And when the parts come in, they finish it. And they're doing that. I mean, they're actually doing that to keep the plants open. And GM just shipped, 65,000 vehicles last quarter to dealers that it had assembled previously and got the parts in and then shipped them to dealers. So, I think this will drag well into 2022, maybe longer as far as the automakers is concerned. I think there will be particular issues that will drag into 23. And the story might change. I mean, that's what we're hearing right now. The story might change again, and there may be bigger issues. Of course, if we had a sudden decline in demand, that would allow everybody to catch up, and that's really what's needed. We need a steep decline in demand for long enough to allow everybody to catch up and to get the supply chain back in order, and to get the transportation networks unclogged, and to get things disentangled, and then the efficiency would return to the system. And right now, everything's so inefficient. Everything is just incredibly inefficient. Lots of people are wasting lots of time trying to make something work, and there's lots of wait times and lots of things are not working out, and the inefficiency is a real problem right now, and it slows everything down, and yet it won't be resolved until we get back to a normal kind of efficiency. And that will be the key test. I don't think we'll see that really in 2022.
Okay. I want to get in a moment to what you, with a substantial decline in demand would look like and what it might be caused by. But beforehand, so right now we have higher prices and we have fewer unit sales across a lot of industries. So if that continues for a protracted period, what will the impact on the economy be, do you think?
Well, that's a problem. It's a problem for lots of reasons. GDP too. GDP includes a measure of price adjustment. So when you sell 10,000 units, normally you get $1,000 for each unit. Now you get $1,200 for each unit. That $200 is taken out of real GDP. And because it's inflation adjusted. So if you sell more units and you're just hiking the prices in terms of real GDP, there should be no impact. Of course, we're not really tracking it that carefully, and we're kind of understating the impact of inflation on GDP, so it doesn't really show up. Now, what's been happening though is not only have prices been rising, but they're prioritizing higher end models. So that's not inflation. So now instead of building, a manufacturer might normally build 1 million vehicles a year. Now that they can't build 1 million because they don't get enough parts, so they build 500,000, but they're building all the high-end stuff. Everything is focused on high-end vehicles, high-end trucks, high-end SUVs. That's why the average transaction price has hit $42,000, because the low end has essentially stopped selling. They're not making them. It's the high end. And that does boost GDP. So, and it boosts profits, and it doesn't necessarily boost labor in any way, because the workers in these manufacturing plants, they don't get paid anymore, whether they make a high end or low end vehicle. but it does show up as a benefit. So going upscale shows up as a benefit in the overall GDP calculation. Long term, you just cannot run an efficient economy and grow it by just focusing on the high end. It just doesn't work. And right now there's a lot of stimulus that has allowed for this to happen. So people have lots of money, whether it's PPP loans or unemployment money or stock market wealth that they've gotten. So the high end is doing really well. And so there's lots of demand for this $70,000, $80,000 pickup trucks, no problem. They're selling like hotcakes, But these people have made this kind of money in the stock market, and they've got $400,000 in PPP loans, and so they're forgivable, and they're going to spend this money. I don't know if this can be sustained. It doesn't look like it to me, but that's the situation we've got. And with food, and that's a real issue. There's plenty of food in the supply chain, but it is tight. The grocery store inventories are tight, as the charts are showing. They're not, they're not at worrisome level tight, but there's not a lot of room there. And so, prices are going to go up on food. That's for a lot of people, that's a big issue. In other goods, some of it is discretionary. You really have to buy a car right now. You can drive what you have for a couple of years. But a lot of these price resets, they're permanent. So I don't think that these new and used vehicle prices will actually come down a whole lot. It looks like this is kind of permanent. And so they're pricing a lot of people out of the market. And that's a problem for future demand. What are you going to do with people that can't afford those prices? And that's been an issue with the auto industry for years, and it's getting a lot worse, a lot faster now.
All right, I want to talk about that in just a moment, sort of the stickiness of these prices. Before I do, I'm going to ask your forgiveness, because I'm going to ask you a potentially uncomfortable question here, but I know it's on the minds of lots of people, which is, and this is sort of the core of why inflation is such a boogeyman for a lot of policymakers. If people are concerned that prices are simply going to go higher from here, should they be stocking up now? And if the answer is yes, does that potentially make the situation worse? As people go and they just clear whatever shelves are still full, they empty those shelves, and then it just compounds the issue even further. So do you have any feedback on that, or any?
Yeah, so my solution to this problem that nobody likes is a buyer's strike. And they happen occasionally, and they happened during the Great Recession, when people refused to buy certain things and prices came down a little bit. A buyer's strike will solve a lot of these problems. And stocking up, hoarding, will make those problems worse, as you pointed out. And personally, I'm going to do neither. I'm going to be reasonable, and if I need something, I'll buy it, and if I don't need it, I won't buy it. I'm not stocking up. I think it's nuts to hoard stuff, but some people like to do that, and that's fine, but some of the shortages that we have are due to hoarding, and we haven't really discussed that in the hoarding in the supply chain, not by consumers necessarily, but by companies. So if you make a certain item and you need a chip for that, and you had an idea that you might be running into shortages, you buy 10 times as many chips as you need so that you get through the next couple of years, and that caused the shortages to become a lot worse. And this has happened, so you.
I'm sorry to interrupt you, but how big of a factor do you think that is to the tightness right now?
I have no idea, but anecdotally, I hear it all over the place. There's little things like a home builder needs to get fasteners. He normally buys, X quantity, and it gets him through a month. And so he goes to his supplier, and the supplier says, I'm out, they're back ordered. You're on the list. I can get you these fasteners 3 months from now. And then instead of buying the normal quantity, the guy orders, 10 times as much. And So he's out of fasteners for 3 months and can't build. And then the fasteners come in and he's getting a lot more, but other people aren't getting it. And so he's not the only one that's doing that. So when you start running into shortages, the reaction is exactly what you pointed out. You're going to avoid a shortage in the future by stocking up and thereby making the shortage worse. And it's not just prices, you're sitting on items that are really badly needed by the industry elsewhere, and you can't use it because you're running at capacity, but your competitors can't run at all because they don't have those parts. And so this is the inefficiency I was talking about a minute ago too. This is an issue, and I don't know how big it is. I have not seen any kind of numbers on it. There's a lot of anecdotal stuff. There's some investigations going on. Inquiries, I guess I should say, and it's a contributing factor at all levels because it's just human nature. Once you get burned with something that's out that's your suppliers out of the stores, when you get your hands on it, whether it's toilet paper or whether it's brake assemblies for your vehicle, you're going to order more than you normally do.
All right. Well, so let's address the question. Will things get back to normal? And I'm saying normal sort of in air quotes here. You mentioned the word efficiency or the current inefficiency of the system right now, but you and I for years and years have talked about how the global supply chain network has actually been designed to be highly efficient in a just-in-time manner, but our concern was that it was highly unresilient and that it was vulnerable to what's happened here, right? Where you get a cascade across the system where one issue, multiplies and creates issues all over it. Do you see us going back when things subside to the same, hyper-tooled just-in-time system, or do you think that it will change? That people will have, they'll remember the scars of this time, and that manufacturers may start, for example, U.S. manufacturers may start sourcing more of their parts domestically, or that prices may stay elevated because companies are taking on additional inventory carrying capacity costs because they don't want to be caught out of stock in the future.
Yeah, human memory is short. So, you may have some changes early on, and then 5 years later, everybody forgot about this, and a new guy comes in, and you're right back to cutting costs down to the bone and back to the supply chain. That's very brittle, and but lessons can be learned. Toyota, which was one of the big proponents of lean inventories and the just-in-time system, they got scrambled. Their supply chains got scrambled in March 2011 when the big tsunami, an earthquake and tsunami hit Japan. And they lost their supply of chips and other components. And their plants were up and running, so they could have built cars, but they couldn't because they didn't have the components. And so they learned a lesson, and they actually came up with a system where they made their suppliers prioritize Toyota orders, and they paid them to do that. And that is especially, they got some critical product lines that were that applied, including semiconductors. And so this worked really well for Toyota early in the semiconductor shortage period. And the inventory they had to carry and the prioritization extended from 3 to 6 months usually for the suppliers. And Toyota figured they'd be through the problems by then. And so that worked really well. And Toyota blew everybody away. And we said it got the chips, and it could build whatever it wanted to, and it could sell. And Toyota at one point became the number one vehicle seller in the United States, and the sales boomed because nobody else had enough product. Well, okay, so the 3 to 6 month window expired this summer, and then a Toyota supplier were off the hook, and they no longer needed to prioritize Toyota, and then Toyota ran out of chips as well. But so the lesson is that Toyota reacted to a catastrophe that happened to its supply chain, and it changed its strategy. And it didn't really talk about it. This is something that came out earlier this year. So it was something that the industry kept fairly quiet, and it's not something that got spread around. Toyota is the only company apparently to do that. And so other companies could do that too, but then it doesn't work anymore. So if everybody demands prioritization from the suppliers, then it doesn't work. So Toyota did this at the expense of other automakers, So if everybody tried to do this, the system wouldn't work. And so you're going back to, should we have more supply? And for how many months do we need to stock up? We're looking at a year now pretty soon, and of the semiconductor shortage. It started last year, and it is late last year. And so this is kind of what we're looking at now. Can you stock up enough to get you through a year of supply issues? And, you can stock up for a while, and you can produce, you can diversify your production. You can bring some production back to the United States. In theory, so that wouldn't cause you to, that wouldn't eliminate some of the issues, but it would eliminate the transportation issues you have with container ships. But it wouldn't, and maybe some issues and specific issues in Asia. But if you're running out of silicon wafers, for example, it doesn't matter where you make the chips. So I think there's going to be a lot of smart minds spending a lot of time trying to figure out how to avoid this, and then we'll come up with some solutions. And after a few years, most of it will be forgotten, and they'll go back to just cutting costs.
Okay, so you're optimistic in the short term, but think that kind of human nature will win out in the long term, which is probably a pretty good prediction, though a little sad reflection on us. All right, Wolf. So I want to get back now as we close up here to your comments that you think these price increases we've seen to date are going to be relatively sticky. I guess two questions for you. One is, you and I haven't even talked about markets at all in this discussion, and that's what we normally talk about. So I'm going to have you back on again relatively soon to talk about, where you see us in the grand story of what's happening in the global economy and the financial markets in general. But, we were scratching our head several years ago at how kind of the average person was getting by with the macro environment situation we had then. And now fast forward past COVID, we've had these double-digit price increases in, I would say, the vast majority of the essentials for living over the past 18 months. So my question to you, Wolf, is like, how are people going to be able to absorb that if these prices are going to literally stick? A lot of people I know didn't have the ability to absorb a 10 to 20% increase in their food costs, their transportation costs, and the cost of just sort of daily durables. And then secondly, these price hikes are probably not done, right? And we've got a lot of inflation pumping into the system. You said these supply chain shortages may last for the next year plus. So it could very well get worse for those people. So what do you see in terms of just the public's ability to absorb this stuff before something breaks?
Yeah, this is where inflation gets to be a political bitch. And, there's a lot of pain and anguish and dissatisfaction when prices go up, and wages go up also, but not enough. And we've had, fairly decent wage increases this year in many sectors, and some of them in some low-end service industries. There have been some pretty substantial wage increases. But your rent goes up 15%. And you get a 10% pay hike. That's tough. And gasoline is up 50%, and you can't afford to live in an expensive city, so you live outside, you commute to work in a restaurant, and so you have a lot of gasoline expenses, and so that gasoline goes up 50%. That hurts, and food goes up. So yeah, gasoline, you can't really downgrade a whole lot. You can't put, water in your tank. You can downgrade on some of the food items, a substitution. This is what people do. They stop eating beef and they, eat chicken or eat no meat or whatever, and there's some strategies to do that. It hurts, it's painful, it's nasty, it makes people feel bad. Yeah, the way you can dodge a rent hike is when the landlord approaches you and it's 15%, you have to move. That and downscale, you move down also, on a small apartment or house. That's a nasty thing to do, to be forced to do, and so you get less, pay the same, and it's just inflation at this level is just a very nasty problem to have, and I think it's going to be the inflation trends are going to be supported also, in addition to all the issues we've talked about. They're going to be supported by wage increases that are now rippling through the system, and they're going to be supported by asset price increases and so forth. So I don't see them going away. And people that, the upper 10, 20% of the income scale and on the wealth scale, they don't really fear 6 or 7, 8% inflation. There are very small portions of the income is spent on gasoline and food, and probably they don't even rent. And whereas at the lower end, that's a much bigger portion where these price hikes are happening. And this is a really, really bad situation. And I think the Fed is reckless in not approaching this. The Fed has never given a damn about the people in the lower half or lower 60, 70% of the income and wealth scale. So the Fed doesn't really care about these people, but it is reckless to just completely run over them. And the Fed has still got the foot on the gas pedal. Like I said the other day, it's got the foot on the accelerator all the way, and it's blowing through every red light in every intersection. And it's still printing money. Interest rates are still at 0%. Meanwhile, we've got a big part of the population now looking at these prices and thinking, "My God, where this is going to go?" And this is really, it's a tough situation. I think the Fed made a gigantic mistake in allowing this to happen. It's making a gigantic mistake in waiting for it to go away on its own. Even if the Fed finally raises the interest rates next year, it'll do so slowly, and inflation will just continue for a while. Monetary policy has a big lag, so it will be years before the Fed will get this inflation under control. And during that time, inflation is the loss of purchasing power of the currency, and it also means that it's the loss of purchasing power of labor denominated in that currency. That's what's happening. That there should be a lot of political pressure being put on the government to get this under control, and I can see some of this already happening. People aren't happy about this.
All right. Well, parting words for the viewers, Wolf. What would your advice be to folks that are watching this and concerned about this, future of potentially years of excessively rising inflation going forward?
I don't know that I have any good advice about this. I went through high inflation in the 70s and 80s, and I got some advice back then. And but back then interest rates were 18%, and you could actually sort of keep up with inflation. Now, if you're an investor, you're betting on housing, you're betting on stocks. Your bonds, you're going to get killed investing in bonds. Interest rates go up. Your bond prices fall, and then you have the yield, which is from the bonds that you bought previously. It's getting eaten up by inflation. So, but the bet on housing and on stocks, I think, is looking very iffy now. And because the Fed will eventually take disinflation seriously, and it will eventually raise interest rates, and it will bring up long-term interest rates by ending QE and unwinding part of its balance sheet. They will do that. And when that happens, these house prices can't persist, and the stocks are going to look different too. So it is really tough, I think, to recommend any particular asset class. If you're thinking that these asset classes respond to higher interest rates and we're going to get, it's tough. I mean, everybody's had a really good run for a long time, and I think the Fed acknowledges that too. That everybody's made a ton of money on the assets, and there may just come a time when you have to give up part of it. And you can put it in cash and lose money to inflation, cash or bonds, treasuries or something like that, and that's reasonable. People are doing that. Or you can say, well, I need to make more money than that. I need to have 5% yield. I'm going to get some real estate and the rental properties and so forth. And those are long-term good bets, but the prices are very high. So your entry into these assets now is at a very difficult point.
Yeah, well, as I said earlier, well, if I'm going to have you back on and us to really dig deep into the market side of things, it's unfair to ask you these questions right here at the very end of this conversation. But as you and I have said before, it's a completely precarious time for today's investors for exactly what you're talking about. A lot of people are saying, oh, higher inflation. Well, then, yeah, I'm going to pile into equities. I'm going to pile into real estate. Those tend to do well. But prices are so dang distorted right now. You're just saying, that party may not be able to continue, and you could get a lot of people who get a very nasty surprise if they push all their capital into those markets, and then we have a large correction. And we have had a number of guest experts on this program specifically predict that they see a sizable correction, as quite likely in the next couple of quarters. And of course, we've got, very venerated investors out there like Jeremy Grantham saying the same thing. All right. Well, I see you sort of nodding as I'm saying this. I'll let you close here with any additional feedback that you want to add to my comments there. But whether you do or you don't, for people that have watched this video, have enjoyed it, and would like to learn more about you and your work, where should they go?
wolfstreet.com. So that's where everything I write is, and it's free. There's no paywall. You can use ad blockers. Works just fine.
Great. All right. Well, look, I'll put the URL up for your website when we do the editing for this video. But anyways, well, thank you so much for joining us. Look forward to having you on again to dive into the market related stuff. But really appreciate you taking your time out of the day to help this audience understand in real time what's going on in this very complicated supply chain, but very important supply chain situation.
Thank you, Adam.
We hope you've been enjoying this discussion with analyst Wolf Richter. As he and I mentioned, it's an incredibly treacherous time for individual investors right now. So if you'd appreciate a free, no strings attached portfolio review by a financial advisor who can help manage your portfolio with the risks that Wolf has highlighted here, just go to wealthion.com and we'll help set one up for you. And if you'd like to see more great experts like Wolf on this program, please take just 2 seconds to support this channel by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it if you haven't already. Thanks so much for doing that, and thanks for watching.